Hello everyone, welcome to EduTap and welcome to today's Finance 360-degree session. So first of all, I hope I'm clearly audible and the screen is visible. So do confirm that everything is fine, and today we are going to discuss two articles. One is from the RBI website and the other one is from the SEBI. Okay, so we are going to discuss the Reserve Bank of India conduct of government business by agency banks, payment of agency commission and oversight. So there are different facts that we have to focus on. So I will mark the important facts also that you have to remember from the examination perspective. The second news article is regarding the SEBI that has allowed the net settlement for the FPI trades. So what kind of trades have been allowed under the net settlement and everything we are going to discuss in today's session. So these are the two articles that we will be discussing. Okay, so let's get started without any delay. So first article that we are going to start with is the RBI notification. So this is the RBI notification that we have to start now. So the Reserve Bank of India conduct of government business by agency banks, payment of agency commission. So this is the master action that the RBI has released. See, the Reserve Bank of India, it is known as the banker for the government. It is known as the banker for the government, right? It is the banker for the government. Like the banks, they are the banks for the customers. The RBI is the banker for the government. That means the government, let's say the government has to collect the taxes. The government has to pay the pensions. The government has to pay the salaries. The government has to collect the fees, fines, dividend. So how the government is going to do so? So the RBI has the responsibility as the banker for the government to take the receipts and to make the payments. But RBI can single-handedly make all the payments and collect all the receipts from the public. Can RBI do so? No, right? That's why there is the agency banks. There are the agency banks. These are the banks that are appointed or authorized by the Reserve Bank of India to act on behalf of the Reserve Bank of India to collect the receipts and to make the payments on behalf of the government. Okay, so this is the idea. Any confusion first of all? So this is the mota idea that the RBI is the banker for the government. RBI has the responsibility to collect the receipts or make the payments on behalf of the government, but RBI cannot do it on the single basis. That's why the agency banks are authorized or they are appointed so that they can collect the receipts for the government and they can make the payments for the government. And the agency banks, they do this kind of activity to get the agency commission, to get the commission from the RBI. In certain cases, the agency banks also get commission from the government also, that we will discuss. So this is the basic idea. So the RBI's framework governing agency commission has been built up through dozens of circulars issued since 2003. These were consolidated into a master circular in April 2025, and the RBI has now elevated the framework on the agency commission from a master circular to master direction. That means basically the RBI has released these master direction while simultaneously repealing the earlier circulars. Now in this master direction, the RBI has informed about the agency banks and the agency commission. Agency commission is the payment made by the RBI to an agency bank for handling the general banking business of the central government and state governments on behalf of the RBI. So RBI is responsible to handle the general banking business for the central government and state governments. Now the RBI, it appoints the agency banks to do these kind of activities, and the agency banks, they get the agency commission from the RBI. Okay? So agency commission is the payment that the RBI is providing to the agency banks for handling the general banking business of the central government and state government on behalf of RBI. However, this commission does not cover the functions related to management of public debt, that we will understand. Now the applicability of this master direction is on the agency banks. Which entities can become the agency banks? So public sector banks, scheduled private sector banks, scheduled payment banks, and the scheduled small finance banks, they can become the agency banks. So there is the chronological order that is also provided. That see, all the public sector banks, they are eligible to conduct the government business as agents of RBI. Okay, so all the public sector banks, they can become the agency banks. But in 2003, 4 private sector banks were first authorized to handle the government business, including the state government business. Then in 2012, all the scheduled private sector banks, they were made eligible at par with the public sector banks to conduct the central government and the state government business. In 2021, the scheduled payment banks and the small finance banks, they were also included in consultation with the Department of Financial Services, Ministry of Finance, to be applicable to become the agency banks. So now the private sector banks, public sector banks, scheduled small finance bank and the payment banks, they can become the agency banks. So remember that which can become the agency banks. So these are the 4 categories of the banks that can become the agency banks. So this is something that is important, that which entities can become the agency banks. Okay, the timeline is not so important, but to remember that which banks can become the agency banks, this is important. Now 33 agency banks are operational across the 4 categories. So that is the idea. Now, guidelines of framework for authorizing an eligible bank as an agency bank. So what is the chronology, or how the bank can become the agency bank? So first of all, for the central government or union territory business, ministry or department will work out a proposal with the applicant bank, and this proposal will be sent to the office of the Controller General of Accounts, which will examine the proposal and forward its recommendation to the Department of Government and Bank Accounts, RBI Central Office. The RBI Central Office, the DGBA, that is the department, will finally examine the proposal, and if the bank is eligible, the RBI will formally appoint the bank and will sign the agreement with the bank, and the bank becomes the agency bank. For the state government business, the same flow goes, but there are certain changes. First of all, respective department of the state government will work out a proposal with the applicant bank, and this proposal is forwarded to the State Finance Department, which will examine and forward its recommendation to the RBI regional office, which will review and add comments, and at last the Department of Government and Bank Accounts in this RBI central office will finally examine the proposal, and the RBI, if finds the bank to be eligible, then the RBI will formally sign the agreement with the bank, and the bank becomes the agency bank. So this is the process actually through which a bank can become the agency bank. So just keep in mind that which department is involved of the RBI central office, so Department of Government and Bank Accounts, and in the central government union territory business, the Office of Controller General of Accounts is involved, while for the state government business, the State Finance Department is involved in the whole process. That is the idea. Now, any approval for authorizing an agency bank for the central government, union territory, state government business will be subject to the condition that the applicant bank should not be placed under the prompt corrective action framework. That means the bank should not be under any corrective actions or moratorium. Okay. So bank should be a healthy bank. It should not be under the prompt corrective action. Now, accreditation, that is authorization of an agency bank for the government business. See, the choice of authorizing or permitting an agency bank for any particular government business, this rests solely with the respective central government department or union territory or state government. So basically, if a bank is chosen for a particular government business, then this is under the central government department or union territory or state government. The government may also discontinue the authorization of that particular bank while keeping RBI informed. Okay, so this is the idea that if accreditation entirely at the discretion of these entities for a particular government business. If there is a particular government business, so the government can choose that which bank will undertake this particular government business. They can also discontinue the accreditation. Once the bank is authorized by RBI to undertake the government business, no further RBI approval is required for deciding the mode of operations, physical or electronic, or the area of operation. So if the RBI has provided its authorization, RBI has signed the agreement and such, and the bank has become the agency bank, after this, no further RBI approval has to be taken for the mode of operation or the area of operation. The operational decisions can be taken independently by the office of the Controller and General Accounts, Controller General of Accounts, or the State Finance Department. So operational decisions are taken independently by the Office of Controller General of Accounts in the central government union territory business and the State Finance Department for the state government business, with only intimation to the RBI. Now, there can be pre-funded schemes. Pre-funded schemes means all the money has already been sent to the bank. So any bank can be chosen. Any bank can be chosen for implementation of the pre-funded schemes, because here the government has already given the money to the bank. So there is no problem in the payments and such, in the flow of payments. So in this case, any bank can be chosen for the implementation of pre-funded schemes without reference to RBI also. Performance of the agency banks will also be seen or reviewed. Okay. Now, which transactions are eligible for agency commission paid by RBI and which transactions are not eligible for the agency commission? So first of all, revenue receipts on behalf of the central or state government. Revenue receipts means the taxes that is collected, fees, fines that are collected, the dividends. Okay, central government, state governments, they get the dividend from their public sector undertakings. Okay, so all these are the revenue receipts that are received by the central or the state governments, and the agency banks, they can receive these kind of revenue receipts, and for receiving these revenue receipts and transferring it for the government, they will get the agency commission paid by the RBI. All payment transactions including the pension payments. So let's say these are the receipts. Now payments. All the payment transaction including the pension payment that is paid by the agency bank on behalf of the central government or the state government. For this also the agency bank will get the agency commission, except for the pre-funded or where the government compensates the agency bank directly. See, remember this, that the agency commission will only be paid by the RBI when the agency banks are undertaken some activity for which the government is not paying, for which the central government, state government is not paying. If the central government has already paid the commission also, then the RBI will also not pay the commission. Okay, it's not like that from here also you are getting the commission, from there also you are getting the commission. No, the RBI has clearly said that if in any case the government is paying, if government is providing you the commission, I will not. Okay, so agency commission will be paid by the RBI for all the payment transactions undertaken by the agency banks, including the pension payments, except the pre-funded or where the government has already compensated the agency bank directly, or where the government compensates the agency bank directly. So double compensation will not be provided, that from government also you are taking the compensation, from RBI also. Any other item of work specially notified by the RBI or stamp duty collections, physical or e-mode, provided agency bank does not charge the public. Let's say from public also you are taking the payment for the stamp duty, the additional fee is taken, and from the RBI also you are asking the agency commission, so that cannot be done. If you have taken the money from the public, if you have taken the fee from the public or the state government, then you cannot ask for the agency commission. Similarly, stamp duty that is collected and remitted to the government treasury even through the franking, like franking means there are certain stamp duty rooms that you must have seen where the stamp duty like are provided and such. So if from such franking related payment flows that are received by the bank and the bank is furthering these flows to the government, so in this case also the agency commission can be taken. So stamp duty that is collected and remitted to the government treasury, including the franking related payment flows where the agency bank is just acting as collecting or remitting bank. In this case also agency commission can be provided by the RBI to the agency banks, but they should not be getting any payment from the central government, state government, or from the public. That is the basic mota idea. Okay, franking related payment flows for the stamp duties, there are certain rooms where the machines are there where the stamp duty forms are provided and such. Okay, so this is the idea. Now, transactions not eligible for agency commission: if the agency banks paying for their own tax liability, they are doing their own task. Okay, so in this case agency commission will not be given. Bank guarantees security deposit by the government contractors. So in the simple, see, basically if the bank is doing any lending activity, if bank is lending, providing the guarantee or such, this is the basic functioning of the bank. For this agency commission will not be provided by RBI. So if bank is providing bank guarantee, security deposit, this comes under the regular functions of the bank. Borrowings of the state government, so if the bank is lending to the state government or to the state government public sector undertakings and such, in this case also no agency commission will be given. Bank services to autonomous or statutory bodies, municipalities, corporations, local bodies, no agency commission is there. Transactions related to gold monetization scheme, in this case also there is no agency commission from the RBI. Letter of credit, bank guarantees, all of this is under the normal functions of the bank, so it also does not get any agency commission from RBI. Pre-funded schemes, because this has been pre-funded by the central government, so for this also there is no agency commission. So remember that for which transactions there is no agency commission, which are the general. So such transactions that are the general activities of the bank, for that there will be no agency commission. For such transactions where the state government or the central government is paying, for that also there will be no agency commission. If the commission is already provided by the central government, state government, so there will be no agency commission. That is the basic idea. Okay. For what kind of transactions there is the agency commission that the agency banks get? For the receipts, for the revenue receipts, for the regular payments on behalf of the government, and stamp duty collections. Okay, for all these kind of transactions, the agency commission can be provided if there is no payment that is taken from the government, in the sense that no commission is taken or compensation, there is no compensation that is taken from the government, then the agency commission will be provided. Now, the rates of agency commission for small saving schemes transactions are decided and borne by the government of India. So for the small saving schemes also, the banks, they are collecting the small saving schemes, Sukanya Samriddhi Yojana, Kisan Samman Nidhi and such. Sorry, not Kisan Samman Nidhi, Kisan Vikas Patra. So through the Kisan Vikas Patra, through the Sukanya Samriddhi Yojana and such, the small saving schemes are there. So banks are receiving the savings and the banks are also paying the interest on the half yearly basis or whatever is required under the small saving schemes. So bank is also taking the money under the small saving schemes and bank is providing the interest rate on behalf of the government. Okay, finally the bank gives the money to the government and the bank government gives the interest that the bank has to pay forward. So in this case, the bank is becoming the intermediary for the government to collect the payments or to make the payments. Okay. So the rates of agency commission for small saving schemes transactions will be decided and borne by the government of India while they are processed and settled at central account section of the RBI. Now RBI has authorized, remember this is important. Now again, this is important. RBI has authorized all the public sector banks along with ICICI Bank, Axis Bank and SDFC Bank to receive subscriptions under the National Savings Time Deposit Scheme, National Savings Scheme, National Savings Recurring Deposit Scheme, National Savings Certificates Scheme, in addition to other existing small savings schemes. So these are the banks that are authorized by the RBI to receive subscriptions and to make the interest payments. Okay, so the banks are public sector banks, all the public sector banks, ICICI Bank, Axis Bank and SDFC Bank, they can become the agency banks and they can, on behalf of the government, they can collect the payments, they can collect the receipts and they can make the payments of interest. Okay. Now, all the transactions related to small savings scheme, the receipt, payment, interest, etc. shall be directly reported to the CS, to the central account section of the RBI on a daily basis, similar to the transactions of the Provident Fund scheme. Okay. Now, reporting of transactions by the agency banks to RBI. So, luggage files shall be uploaded in RBI Kuboyer at 6 p.m. prescribed by the Office of Principal, Chief Controller of Accounts, Central Board of Indirect Taxes and Customs, Central Board of Direct Taxes. So if the bank, agency bank is collecting the direct taxes, indirect taxes and the other customs and duties, in this case the luggage file, that is the electronic form of file in the XML format, this has to be reported by the banks to RBI at 6 p.m. Okay, on the daily basis instead of the public holidays. For state government transactions, the monthly balance transfer by agency bank take place on the 5th day of the succeeding month. So again, this is something that you have to keep in mind, that let's say for March, there are some receipts that are received, like the property taxes are received on behalf of the state government, or there are some dividends that are received and such, and there are also the payments that have been made. Okay, the pension has been given, or let's say there was some payments that were made, and so whatever is the collection, minus whatever is the payment. So whatever is the balance that has to be transferred to the government by the 5th of the succeeding month, that is by the 5th of April. That means before the 4th day of the succeeding month, there should be all the settlement and the accounting process that should happen smoothly, so that by the 5th day of the succeeding month, the balance transfer is possible. So for state government transactions, the monthly balance transfer by agency banks take place on the 5th day of the succeeding month, so that the reporting and all the accounting settlement should happen before 4th day of the succeeding month. If the central government transactions, electronic or physical mode, they are reported after 90 days from the date of transaction, or if there is any update, the agency bank must first obtain prior approval from the concerned ministry or department and submit the approval separately to the RBI. So basically, if the central government transactions, they are reported or they are updated after 90 days from the date of transaction, in this case, first approval has to be taken from the concerned ministry or department to submit these kind of or to report these kind of transactions and submit that approval separately to RBI. While reporting such transactions for settlement, agency bank must report all gold monetization scheme transactions daily through the designated government account maintained at the central account section. Okay, so this is the basic idea, that for the, like we have understood that for small savings schemes, the government will pay the commission basically, and the RBI has authorized public sector banks, ICICI Bank, SDFC Bank and the Axis Bank to undertake the small savings schemes and to undertake the other kind of schemes on behalf of the government and to receive the subscriptions to make the payments. Okay. Next, we discussed that the luggage files or the electronic form of the files have to be reported by the banks to RBI on the daily basis at 6 p.m. if the files are related to the customs, direct taxes, indirect taxes, and the state government transactions must have the balance transfer by the 5th of the succeeding month. If the central government transactions are reported after 90 days, in this case, approvals have to be taken because this is a delayed reporting that is happening. Agency banks must report all gold monetization scheme transactions daily. Now, rates of agency commission, this is something that is important. Okay, receipts, physical mode, if the money has been received in the physical mode, let's say taxes have been received in the physical mode, fees, fines have been received in the physical mode. So if the receipts are in the physical mode at the bank branch, so per transaction will get the agency commission to the bank of 40 rupees. If the receipts are in e mode, for per transaction 12 rupee will be the agency commission. If the pension payments are being made by the bank, so per transaction 80 rupees will be the agency commission. Payments other than pension, so per 100 rupees turnover 7 paise per 100 rupees. If the payments are other than pension, so for per 100 rupees turnover, for per 100 rupees 7 paise per 100 rupees will be the agency commission. Any confusion in this? So this is the basic idea. This is something that you have to remember, and this is very, very important. So I've marked the important points. The data are mainly important, like the 5th day, the 90 days clause, as well as here the banks, which banks have been authorized, the transactions also you have to remember which are eligible for the agency commission, which are not. Okay, and which banks can provide it can be the agency bank. So the 4 category of bank can be the agency bank. Now, if a single GST challan is there, if a single GST official document or the official accounting document is being signed, or if there is a single GST challan, for that only one transaction will be calculated. If the single challan in non-GST cases, for that also one transaction. If there is a single GST challan, if there is a single GST official document that is submitted, or the transaction document that is submitted, so for that there will be only one transaction that will be counted. Now, submission of agency commission claims by agency banks. So the submission for central government transaction, the central account section Nagpur RBI, GST receipts, and for such indirect taxes that is collected, customs duties that is collected, Mumbai regional office of RBI, the state government transaction, respective RBI regional office, special deposit scheme transactions, the central accounts section Nagpur RBI. Okay, submission timeline. So this is important. Now this is important. Agency bank shall furnish their claims for agency commission to RBI within 60 calendar days from the end of quarter in which the transactions were conducted. Okay, they have to submit some certificates that is signed respectively by the branch officials and the chartered accountants or the cost accountants. These certificates are required in addition to the usual certificate issued by the executive director or chief general manager in charge of the government business. Now coming to the pension, now this is also very important because there are certain things that you have to remember. If the agency bank is handling the entire pension disbursement process including the pension calculation, they are eligible to claim agency commission at what rupee? So if the agency banks, they are handling the entire pension disbursement process, so for per transaction they will receive 80 rupees for pension payment, right? However, if the pension calculation and related work are being carried out by the concerned government department of treasury and the bank merely just sends the payment, in this case this kind of transaction will be classified as other than pension payment, and rupee 7 per 100 rupees, 7 paise per 100 rupees will be the agency commission. So remember that if the agency banks are handling the whole of the pension disbursement process from the calculation till the disbursement, so this will be considered under the pension payment. This will be considered under the pension payment, and per transaction 80 rupees will be the agency commission for the bank. But if the pension calculation is happening at the treasury or the government department is doing the pension calculation and only disbursement is being done by the bank, then this will be considered under the payment other than pension, and here 7 paise per 100 rupee only will be received by the bank as the agency commission. Okay, so if the concerned government department or treasury, they are doing the pension calculation, bank merely credits or sends the money to the pensioner account. So in this case, this will be other than pension payment. The number of pension transactions that are eligible for agency commission cannot exceed 14 transactions per pensioner in a financial year, 12 monthly pension credits, and a maximum 2 additional transactions for arrears arising due to increase in the dearness relief wherever applicable. Okay, so in total only for the 14 transaction per pensioner, the agency commission will be allowed in a financial year. 12 monthly pension credits and 2 additional transactions for the arrears can happen. Next, commission sharing between banks. So when work is shared between two agency banks, the commission is split 75 to 25. So if the bank is handling all the transaction at the complete manner, that means the bank is handling the transaction at all stages up to the stage of dispatch of the scrolls are basically the payment scroll or the receipt scroll, which is the physical or electronic statement that is submitted by the agency bank that lists the payment made and claimed from the government account at the RBI for ministry or department on a given date. Okay, so basically if the bank is handling the transaction, if the bank is making the payment or getting the receipt, as well as the bank itself is also dispatching the scrolls, that is the electronic statement or the physical statement, and the challans, that is the transactions or the checks to the pay and account offices and treasuries or sub treasuries, that means the whole process is undertaken by a agency bank, so it will get 100% of commission share. But let's say that the dealing agency bank branch passes the scrolls or documents. So dealing branch is the branch that is doing the transaction, is undertaking the transaction, paying the pension or is getting the receipts, but it passes the scrolls or documents to RBI branch or another agency bank. So the agency bank branch receiving the scrolls from other agency banks and handling the account and dispatch of the scrolls to the pay and account offices, treasuries, etc. So the dealing branch will get 75% and the other branch will get 25%. So basically what is happening, that let's say that the bank is handling the whole process of doing the transaction as well as the bank is the one that is also dispatching the scrolls, is also dispatching the physical or electronic statement that has to be submitted, and the challans, that is the transaction document or the checks to the pay and account offices and treasuries or sub treasuries. So the whole process is handled by the bank. So 100% will be the agency commission that will go to this agency bank. But let's say the dealing branch, there is a dealing branch and there is a accounting branch. So dealing branch is doing the transaction, is making the payment or getting the receipt, and it passes the scrolls such as for the physical or electronic statement or documents to the RBI branch or another agency bank. So the dealing branch that is undertaking the transaction will get 75% of the agency commission, while the agency bank branch, which is the accounting branch basically, which is submitting the statements, that is receiving the scrolls from another agency bank and handling the accounting and dispatch of the scrolls to the pay and accounts offices, treasuries, etc., it will get 25% of agency commission. So the agency commission can be divided in between two agency banks on the basis of the dealing branch and the accounting branch. Dealing branch will get 75% of the commission and accounting branch will get 25% of the commission. Settlement of agency commission. Basically, all ABs should settle their agency transactions for funds and agency commission directly with the respective RO of the RBI. So you can read this, nothing much important. Now, the last point that is important is here. Oversight of government business in agency bank. So inspection by RBI at branches undertaking government business, central pension processing centers, and head office of the agency banks. So basically, the inspection will be done by the RBI at the branches that are undertaking the government business, the central pension processing centers, and the head office of the agency bank. The inspection will be done by the RBI. Office or branches will be advised of action points, and the action points will be divided into major action points and the other. The major action points, if there are any major action points, in response to that, within 30 days, there is a response that the branch has to send, the head office has to send within 30 days to the regional office of RBI. So basically, RBI will do the inspection and the action points will be divided into major action points and the other. For the major action points, the response has to be sent by the bank branch within 30 days. Okay? For the other action points, they have to be rectified internally and reviewed by internal audit. Now also the video is blur. Just a second. Okay. Now the camera is stuck. Let's just close the camera. Okay. Let's just focus here. Um, so action points are classified as major and other. So this we have discussed. Now, offsite monitoring. So agency banks must report government business details to Department of Government and bank accounts with copy to their jurisdictional RO. So this is the basic idea. Now, the important point here is that as per the agreement between the agency bank and the RBI, violation or non-compliance of instructions. So as per the agreement between the agency bank and RBI, the violation or non-compliance of instructions issued by the government and or RBI shall attract imposition of penalty. So if there is any violation that is done by the agency bank, if there is any non-compliance of the instructions, so in this case the penalty will be applied on the agency banks. Agency banks will be liable to pay penal interest at bank rate plus 2% for any settled wrong agency commission claims. So if there is any wrong agency commission claims, in this case the bank rate plus 2% of the penalty will be taken. Got it? So this is the important point that you have to remember. This is the important point that you have to remember. This is it. So in this whole article, the important points, let me just mark the important points that you have to remember, and then we will go to the next article. Okay. So first of all, here you have to remember that which can become the agency banks. So these are the entities that can become the agency banks. Then the process, just read the process once, that which authority is responsible in case of the central government union territory business, and which is responsible for the state government business appointment of the agency bank, which authority is involved or which department is involved in such. Then this is also very important. In this case, just the transactions that are eligible for agency commission or the transactions not eligible for agency commission, this is important. Next, RBI has authorized which particular banks for the small saving schemes or for such kind of schemes, this is important. Next, 5th day of the succeeding month for the balance transfer for the state governments, and for the central government transactions reported if after 90 days. So there are certain additional steps that will have to be undertaken. Okay, this is very, very important, very, very important. Next, again, agency commission has to be claimed within 60 calendar days from the end of the quarter. So this is also important. Yes, and then regarding the pension, other than pension payment transactions, this will be considered if the pension calculation is undertaken by the concerned government department or treasury and the bank merely credits the pension, then this will come under the other than pension payment transaction. Okay, and agency commission cannot exceed 14 transactions per pensioner in a financial year. So number of pension transactions that are eligible for agency commission cannot exceed 14 transactions per pensioner, 12 monthly and 2 additional transactions. 75-25 ratio also important. And the last important point was your bank rate plus 2%, that is the penalty that will be charged or the penal interest that will be charged for any settled wrong agency commission. So these are the important points. Now coming to the next article, that is SEBI has allowed net settlement for FPI trades, deadline set for December 2026. Okay, so SEBI has allowed the net settlement for FPI trades. So in this case, what has happened that the deadline, the SEBI has operationalized the net settlement of funds for the foreign portfolio investors in the cash market. So basically, first we have to understand that what are the outright transactions, then we will understand that what is this net settlement of funds. Okay, outright transactions are the transactions where there is only one-sided transaction that is happening in a security. There is only the buy or the sell. It is only the buy or the sell transaction for a particular security, for a particular share and such. Okay, as well as the outright transactions, they are delivered. They are deliverable transactions. That means if you have initiated the transaction, you have to deliver it. Okay, now can we say that this is the outright transaction? If you are buying the shares of Reliance and you are selling the shares of Reliance, is this outright transaction? Is this outright transaction? If you want to buy the shares of Reliance, if you want to sell the shares of Reliance, this is not outright transaction. Why is it so? Because in this case, you are not doing the one-sided transaction for a security. You are also buying it, you are also selling it. So this is not the outright transaction. This is not the outright transaction. In this case, can we say that this is the outright transaction where you are buying the Infosys shares? Yes, this is the outright transaction, because here you are only taking a one-sided transaction for a particular share, for a particular security. If you are selling the TCS shares, this is also the outright transaction for the TCS, because here you are only selling. You are only doing the one-sided transaction. Okay, so this is the idea that SEBI has allowed the net settlement for the foreign portfolio trades in the outright transactions. For the outright transactions only, the net settlement has been allowed. Net settlement means, see here, if you are buying the Reliance shares, how much do you have to pay? 50 crores you will have to pay. You will have to pay 50 crores. Okay, if you are selling the Reliance shares, how much you will be getting? you will be getting 30 crores, okay, from the clearing corporation, because the clearing corporation is the one that at last settles the claims, or the settles the transaction. Okay, so clearing corporation is the one that is clearing the transaction and settling the transaction. So you will have to pay 50 crores to the clearing corporation. You will get 30 crores from the clearing corporation for your non-outright transaction that you are doing, because here you are buying and selling the same security. So here the netting is not allowed. For the non-outright transactions, the net settlement is not allowed. That means the gross settlement will happen. You will have to pay the amount that has to be paid. You will have to collect the amount that has to be collected. But in case of the outright transaction, you are doing the outright transaction of the Infosys shares, you are doing the outright transaction of the T-Shares shares, you are buying the Infosys shares of 100 crores. So you have to pay the clearing corporation 100 crores. You are selling the T-Shares shares worth 70 crore. So you will get from the clearing corporation, you will get 70 crores. So here the net settlement will be how much? The net settlement will be how much? 30 crores, because you only have to pay the net amount. Okay, so here the net settlement is 30 crores. Let's say I am purchasing the shares of Reliance Telecom, and I am selling the shares of CDSL. Is this outright transaction? If I'm purchasing the shares of Reliance Telecom and I'm selling the shares of CDSL, is this outright transaction in the Reliance Telecom and the CDSL shares? Yes or no? Yes, this is the outright transaction where only one-sided transaction is happening. Means I'm only buying the Reliance Telecom shares, I'm not selling it also. And in the CDSL also, I'm only selling it, I'm not taking the opposite position. So this is outright transaction. Okay, in this case, let's say I want to buy the Reliance Telecom shares worth 50 crore and I'm selling CDSL shares worth 150 crores. So what is the net settlement that will happen? If I'm buying 50 crores worth of shares, I'm selling 150 crores worth of shares. So net settlement will be 100 crores. So the clearing corporation will have to pay me 100 crores, or clearing corporation will be settling the amount of 100 crores. So this is the basic idea, that in the outright transaction, netting of the fund obligations will be allowed only for the outright transactions. That is where an FPI has either only the buy position in a particular security or the sell position in a particular security within a settlement cycle. So the netting of fund obligations will be allowed in these kind of outright transactions. Okay. However, settlement of securities. Now, can settlement of securities, the settlement of shares, can it happen on the net basis, that you are only getting part of the Infosys shares, or you are only selling part of the TCS when you have promised to sell this much worth of the shares? So can you get the settlement of shares in the net basis and not gross? No. The settlement of shares, the settlement of security should also be on the gross basis, should only be on the gross basis. Only the fund can be netted, only the fund obligation can be netted, but the settlement of securities will continue on a gross basis, ensuring that delivery and ownership transfer mechanism works smoothly. So this is the whole idea that I hope is very much clear. So SEBI has indicated that this change in the netting of the fund transactions, the net fund transactions in the outright transactions, so these kind of change will significantly reduce the paying obligations potentially by up to 50%, thereby improving the capital efficiency for FPIs. So before, let's say, if you want to purchase, if you are purchasing the shares or you are selling the shares, you had to pay the gross amount for both, and the clearing corporation had to undertake multiple transactions. Let's say you are purchasing the Reliance Telecom shares, you are selling the CDSL shares, so multiple transactions had to be undertaken. But now the transactions will be on the net basis. So in one transaction, the clearing corporation, in what settlement cycle, one transaction, the clearing corporation can settle this transaction. Okay, so this is the idea. So the netting facility will apply strictly to the outright transactions that are the one-sided transaction for a particular security, and they are delivery-based trades, ensuring clarity and reducing operational complexity. In cases where both buy and sell transactions occur in the same security, these are not the outright transactions because the buy and sell, both positions are in the same security. So in this case, net transaction is not possible, the net fund transaction is not possible, and the gross transaction has to happen. Okay, gross basis settlement has to happen. Where there is a mismatch, if purchase obligations are more than the sales, that means you are purchasing more than you are selling, so you have to pay the net amount for the outright transactions. And so this is the idea. Now, the statutory levies such as securities transaction tax and stamp duty will remain unchanged. So securities transaction tax, whenever you are transacting in the securities, you have to pay this tax, that will be applicable, and the stamp duty will remain unchanged because whatever transactions you are undertaking, for that you have to pay the tax and the stamp duty. Nothing has been changed here. The implementation framework will be finalized by custodians and designated depository participants, that how this framework will be applicable, okay, or implemented. So what we have understood is that the net settlement has been allowed. The net settlement has been allowed, but only for the outright transactions undertaken by the FPIs, foreign portfolio investors. Outright transactions means that for a particular share, for a particular security, there is only one-sided position that you are taking. You are either buying it or you are selling it. Non-outright transactions, that means you are buying and selling the same security. In this case of the non-outright transactions, the net settlement is not allowed. Only the gross settlement can be done. Only the gross settlement can be done. Okay, so this is the mota basic idea, that for the non-outright transactions, the gross settlement will continue for the funds, but for the outright transaction, net settlement of funds will happen. But in case of shares, the shares should be gross settled. That means whatever shares are being transacted, whatever security is being transacted, the security cannot be net settled. The security, because if you are buying 100 shares of Infosys, you should get the 100 shares of Infosys. If you are selling 70 shares of TCS or 60 shares of TCS, that should be sold completely, right? So the idea is that in the shares, in the security, the net settlement is not possible at all because the different shares have different value and such. So in the shares, in the security, gross settlement should only happen. So these are the two important points. Netting of fund obligation has been allowed for the FPI outright transactions, but the settlement of securities will continue on a gross basis. This is all. Okay. And the STT and the stamp duty will continue, will remain unchanged. The implementation framework will be finalized by the custodians and designated depository participants. Now, this is the first question. I hope you will be easily able to answer this question. Consider the following statements regarding pension-related agency commission. So, agency commission at pension payments rates is applicable only if the bank performs the entire pension disbursement work, including the pension calculation. So, agency commission at the pension payment rate is payable only if the bank performs the entire pension disbursement work, including the pension calculation. The number of pension transactions eligible for agency commission cannot exceed 14 per pensioner per financial year. The agency commission rate for pension payments with effect from 1st April 2025 is 40 rupee per transaction. So which of the above statements is or are correct? That you have to answer. So this is the first question. I hope you will be easily able to answer this question. Which of the above statements is or are correct? That you have to tell. Next question is, under the SEBI's framework, netting of fund obligations will be permitted only for what kind of transactions as well as for what kind of traders? For the retail investors, for the institutional investors, for the foreign portfolio investors, for the non-institutional investors, for the accredited investors. For which kind of investors the netting of fund obligations will be permitted? And for what kind of transactions? So these are the two questions that you have to answer. Okay, so this is it for today. Thank you everyone for joining the session, and now we will meet in the next session. Okay, so if there is any confusion, you can ask in the comment section below, and do try to answer the questions in the comment section. You will get the PDF of the session by Monday. I think the support team will provide you the PDF by Monday, and you will get the PDF in the Telegram channel of EduTap So this is the idea. So thank you everyone. Thank you for joining. And sorry for the camera issue. I don't know why it happened. But if I close the system, then the whole